Now, the last type of firm structure is called a corporation. And again, that's what this class is all about. And a corporation is typically for the biggest and largest and most complicated firms. Now, it's not easy to set up. You have to file a lot of legal documentation. It's not cheap to do that. So it's not really a good strategy. It's not really a good type for a firm to evolve into until they have reached a certain point of maturity and size. So what I mean by that is that a corporation, it has to be formed in a very specific way. And one of those things is they have to write a corporate charter. So it's like, kind of like a constitution for the firm where they lay out what the firm is, how the firm is run and governed. Are they going to have a CEO and a CFO? Or are they going to have two CEOs or just a president or whatever? All of that stuff is laid out in the corporate charter. And that is can be a sizable document. It can say lots of different things. For instance, in Google's original corporate charter, the first thing that they wrote on the top of the charter was that their motto was going to be "Don't be evil." Okay? Now, about 5-6 years ago, they wrote a new corporate charter and they took that out. Take that as you will, but your corporate charter says, lays out the identity of the firm, right? And it also lays out the structure of the firm. So you need a bunch of lawyers to help you draft that, and you file it with the state and with the country, and you organize as a corporation, and now you have gained and lost some things. Right? Some of the things that you've gained are unlimited liability for the owners. Right? When you form a corporation, you form a completely separate legal entity from the ownership. So no longer is the company and the owner the same thing. Now the company is one thing and the owner is another. And that separation is important for a number of reasons, but the biggest reason is that it provides legal protection. The owners now have unlimited liability, completely limited liability from the actions and liabilities of the company. So if the company defaults on its debt, they cannot come after the owners of a corporation. If a company gets sued by someone, they cannot come after the owners of the operation. All that would happen is the owners would lose the value of the company if the company had to, say, dissolve because a lawsuit wiped out all of their assets. Okay? But that they could not then come after the owners for some of their personal assets. So this completely limited liability is a very, very valuable thing as a company gets larger and more complex. Now, that does not mean that there are no downsides. There are plenty of downsides, and we'll talk about those. Right? One of the other things that this corporate entity, separate entity brings to the table, though, is that it now becomes extremely easy, particularly for public firms, but also for private firms, for the owners of the firm to move on or change. Right? So in a corporation, the ownership shares of the firm. So it might just be two people, in which case me and my cousin would have 50% of the shares, or it might be 500 people, in which we all had 1/500th share of the company's ownership. We would own this company and we could move on from this company by selling our share to someone else. Now, in a private firm, that's kind of difficult. We could sell it to the existing owners. We could sell it to a new owner. We would just have to identify and locate those potential buyers and sellers ourselves. In a public firm, this is all localized in the stock market, in a market exchange where you can post that you're willing to sell your ownership share in Apple, and someone can post that they're willing to buy it. And you can meet and completely anonymously trade hands in these ownership shares without really any transaction costs whatsoever. Right? So you could become an owner in Apple by buying a share and sell that share within the space of a handful of minutes. And so this idea that this is a very valuable thing, that we've moved from a sole proprietorship, which is so tied to the proprietor that it's incredibly difficult to sell or move on from, to something that is completely the opposite. If I die, my shares would go to my kids if I had them, and their kids if they had them, and so on and so forth. If I would just want to sell, I can sell. If I want to buy more, I can buy more. there's no restrictions to the movement in and out of the ownership of a corporation. Okay. Now, the downsides are significant, right? You don't get things in finance without having to trade off other things. That's sort of one of the central themes of this class, is that finance is all about trade-offs. And anytime you get something valuable, you also have to give up something valuable. And one of the things that you give up when you form a corporation is the ease of forming it. You now have, to file financial statements and things like that. It all becomes more complicated, the recording and things like that. The taxes get more complicated. The corporation, because it's now its own legal entity, pays its own taxes separate from the individual owners. In fact, the corporate structure gives rise to what we call corporate double taxation, which is where the company pays taxes on its earnings and then pays out some of those earnings as dividends to its owners, who then must pay taxes again on the dividends they receive. Okay, so the earnings of a corporation are taxed twice, and that is corporate double taxation. Now, they're not taxed at the same, they're taxed at different levels, so ultimately it may be the same as the tax that is paid by a sole proprietor, but it does complicate the legal structure a little bit. Okay? So those are the three corporate structures. We won't spend a lot of time talking about the first two types. Again, this is a corporate finance class, so we're going to focus on the finance of corporations. But one of the things that a corporation does is, once we have divorced the company from the owners, we actually create some interesting and troubling set of incentives for the people that now own and run these firms. Okay? So with a sole proprietorship, me and my cousin run the business. Or we can just go down to me. I run the business. I make all the decisions. I act and decide for the business in the way that is best for myself and the business by extension. Right? So all of the decisions I'm making are personally guided. Right? So I make decisions about investment and taking out loans and things like that. And in the back of my mind, I'm always thinking about, how can all of this blow back on me, or how can all of this make me better off? Right? I don't want to take out huge loans, because if I default on those loans, if I can't pay them back, then the banks are going to come after all my personal savings and assets and home and things like that. So I'm always thinking about that. I'm also thinking about all the things that I might be willing to do. Maybe I'm willing to take a risk or take a chance on a new investment in order to personally enrich myself. Okay? Once we have separated the company from the owner, what we often do is also separate the owner from the management. Right? So, for instance, if I buy a share of Apple today, I become an owner of Apple, albeit a small owner of Apple. But even if I was a big owner of Apple, like Warren Buffett, he's one of their biggest individual shareholders. He owns like 5% of the company or something. So even if we're Warren Buffett and we're incredibly famous for our financial acumen and our investment and our pedigree and all that, I don't actually get any choice about how Apple is run, right? Because the owners are now completely separated from the company. The company itself is going to be the leadership of the company is going to decide how the company's run. And it's very rare that the owners of the firm, or even the biggest owners of the firm, have any say in that, right? Now, there are some cases where the founders of a big company own a controlling stake in the firm, and so they get more say. But that's more rare than anything else. Okay? So we have created now this dichotomy where the ownership appoints a manager to run the company for the ownership. Right? And so the goals of the management and the goals of the owners, which we are also sometimes called shareholders, are not always the same. Okay? And so that means that within the structure of a corporation, we have to think about how these goals work and who and what, or in other words, maybe the better way to say it is, we have to think about the way that the goals should work and how we want to encourage both of these sides to behave so that their goals align with each other. Right? So just the straight up book answer to what are managers' goals is that a manager's goal is to maximize shareholder profit. And all that means is that a manager should run the company so that they generate the most money for the owners, the shareholders of the firm. Right? Now, that does not have to be the only goal of a manager. It just happens to be the goal that is most easily agreed upon by all the shareholders. Right? So for instance, if the way that we set the management goals is all of the shareholders would get together and agree on them. So we could, if there was only two of us, say it's just me and my cousin, we could have all sorts of goals for the managers. We want the manager to, yes, make money, but we also want the manager to, take care of the environment, and we want the manager to make sure that, they are helping our local economy grow and helping out the homeless and all these kinds of different kinds of goals. Right? We want them to be socially involved and environmentally aware and all these kinds of things. And if it's just the two of us and we have generally think alike, then we can say, yeah, you don't always have to focus on profit. You can focus on all these other things. That gets more difficult when we say have 500 shareholders. And it gets much more difficult when we say have 500,000 shareholders or 5 million shareholders. Because now we have all these competing interests. The goals of the shareholders may not be the same as each other, much less as the management team. Right? What we can all agree on is that we don't buy an ownership stake of the company for nothing. The reason we buy a share in a company is that we are hoping that that company is profitable and gives us our share of the profit as a dividend. And we're hoping that the company gets more and more profitable so that the price of our share grows and grows and we become personally wealthier. Right? So we are buying a share in a company in the hopes of getting some piece of that company in financial value. Now, we as shareholders could try to agree that the company should have other goals other than profit. And sometimes companies are successful in that. For instance, Patagonia is something called a benefit corp. A benefit corp. And they explicitly, as part of the operations of the firm, say not only are we going to focus on trying to generate a profit, but we're also going to focus on trying to help the environment. And that is not selfless necessarily for a company like Patagonia, who sells outdoor and recreation activity. If the environment goes completely crap, then of course they are not going to sell much. So you can't say it's selfless, but on the other hand, it is an admirable goal, and it's something that they have agreed to do, sometimes in spite of profit. And if all of the shareholders agree on that, then that's fine. If they wanted to also say, now we're going to focus on social mobility or things like that, we're going to try and help the poor, they would need to get all of the shareholders to agree that this was a goal that they could, again, do sometimes in spite of profitability. And that is what becomes difficult, because even if we all are like-minded people and we all want to use companies, our investment, our ownership of companies to better the world, we might not even agree on the best ways to do that, much less the same ways to do that. Okay? So the central thing that we can all agree on is that we want to make sure that the company is making money. And so typically, we say the goal of the manager is to maximize shareholder value. And a shareholder's goal is to maximize their own value. And we try to make sure that these two things align. And so that's one of the goals of good financial management, is that we find ways and methods to align the goals of managers and shareholders in the hopes that we get some agreement on what they are both trying to get out of the firm. And whether that comes down to just sort of the central function of the firm, which is to maximize profit, or whether we extend that central function to incorporate other kinds of goals for the management team that the shareholders are in agreement with, is sort of up to the collective bargaining of both sides. And financial management is going to be sort of uniquely in the middle of these two goals. And that's how we avoid what are called agency costs, where the agent is the manager, because they are the agent of the owners acting on behalf of the owners in running the firm. Right? So there can be costs of this agency role if the management goals and the shareholders' goals are not aligned. And sometimes they can be really sort of mundane costs, like communication is hard to do when you have 5 million shareholders and one manager. For instance, the shareholders of Microsoft all gather once a year, or they did all gather once a year at what's called the annual meeting of Microsoft, and they would hold that meeting in the Seattle Seahawks Stadium because Microsoft is headquartered in Seattle. So how you get any kind of agreement or or even just the cost of putting on a show like that in general is really difficult. So there is some mundane costs. There are also just some outrageous costs. So there are multiple and many cases of, basically fraud perpetrated by the managers against the owners of the firm where they are misusing the shareholders' money. So there are lots of unusual examples. For instance, there is a pretty famous example of a past CEO of General Electric who who was well known and well respected. He was sort of a championed CEO. He ran the firm for like 20 years. He was always put up on the pedestal as this is, the CEO that you want to emulate and things like that. And then it came out after he retired and the next CEO took his place and was going sort of through back some of the old stuff that the original CEO had been engaged in some really unusual and shady stuff. So, for instance, the thing that always stuck out to me was that, however you feel about company executives flying around on a private plane that the company owns, and there are, I think, somewhat valid reasons for that. This guy used to fly 2 private planes. He would have one take him and his staff, and then he would have an empty one fly behind them just in case the first one broke down. They would have a jet so that they could get back without having to fly commercial, right? So however you feel about the first jet, and maybe you think it's completely a waste of money, and I tend to agree with that, but I'm sure there are companies would disagree with me. I don't think anybody can get behind this fact that this guy had 2 jets just because he was so averse to flying back in the event of an unfixable breakdown of the first jet, right? So an obvious misuse of shareholder funds. Or we have cases of pure fraud where you say the CEO of I think he was the CEO of Tyco, this toy company that went bankrupt during the Enron scandal, it eventually came out and he was convicted and put in prison. But he had used company money to throw his wife a birthday party in Greece that cost the company $500,000, and he had billed the company $30,000 for a shower curtain. So that's just pure fraud. Right? This is the manager, the agent stealing from the owners because there is this divorce between oversight, where the shareholders can't be watching the manager because we're not there, and we're trusting the agent to act on our behalf, but there doesn't always happen. And so the goal of financial management is to try and make sure that the goals of these 2 groups are aligned so that we don't end up, at the extreme in these cases of fraud, but even in the interim with just excess costs associated with having an agent run your business for you. Okay? So all of that is just a broad overview of finance and corporate finance in general and what we're talking about and what our goals are. So this is the outline of what we're going to go in the class. And the rest of this lecture is just going to be the refresher on accounting, and specifically from accounting, the things that we want to take out of the accounting statements and the ways that we're going to use them or that a financial manager would use them that might be different